All right, good afternoon, everybody. Happy Monday. I hope you all enjoyed the weekend. This is Dylan with the Year Zero Report, and this is going to be your daily brief for September 19th, 2022. So, we have a few stories to get into as always, and we'll wrap up with the markets, and we'll also go over the day ahead energy prices in the Eurozone, as well as the cyber threat map as always. But today's story is over the weekend, we saw Biden at a car show. He was interviewed. I believe that car show was in Detroit. I might be wrong on the location. Nonetheless, he was interviewed and asked during that interview if the pandemic was over, and he declared that indeed it was over. So we're going to talk about the repercussions of a declaration as such from the president. One of which would be that everybody that's been affected by the vaccine mandates here in the United States, either through an employer or the federal government, U.S. military, I would recommend now is a great time to go ahead and start writing up a cease and desist letters to those operations of employment, whether it's the federal government or private sector, quoting what Biden had stated at that car show, showing that the President of the United States has now declared that there is no longer a pandemic. Therefore, they can no longer keep you from working, or if they have fired you, you can begin legal action on that if you haven't already done so. But certainly, cease and desist letters are in order now. So it's a big advancement, and it's interesting because we have a story right after this that contradicts what the president's saying himself, if you consider him the president. I don't say that as though I believe such. It's just terminology, I suppose. It's easier to come off the tongue that way. But the Biden regime, nonetheless, has declared that the pandemic's over. So we're going to talk about how just after that, shortly after that announcement, we saw that New York City fired 850 teachers. So let's hop over into some stories here. So getting right into it, on the New York Post, we can see here that 850 more unvaxxed New York City teacher aides fired for not complying with the mandate. So given what the declaration from the Biden regime was over the weekend at that car show, this is no longer justified, in my opinion, what we're seeing here in New York. So cease and desist letters are in order, but 850 more. So I'm not sure of what the exact figure was prior to this 850. Perhaps it's quoted in here. Any article, video, tweet I might show you guys, all that stuff's going to be linked below in the description box so that you guys can source it yourself and feel confident sharing out this information. As well as just below that comment section, you're going to see all of the links to follow us, whether it be on Telegram, Rumble. You can support us on Patreon. We're on Bitchute. We're on YouTube. We'll be adding on another one as well, an affiliate sister channel with a friend of mine. So we'll be publishing that later on today as well. But you can find everything down in that description box. But another 850 teachers, the article goes on to say the City Department of Education has axed another 850 teachers and classroom aides, bringing the total to nearly 2,000 school employees. So there's your total right there. This is crazy. I mean, it's orchestrated collapse. The kids are already not getting a proper education in the public education sector. Now you're removing more teachers. It's draconian, very draconian, orchestrated collapse, right? So let's move over to the next story here. This is going to be from Zero Hedge, dated this morning. Canary in the tax mine, California sees an 11% drop in revenue. So we're seeing 11% drop. Many, myself included, have spoken on this for the last 2 years, that with the amount of draconian policy that we saw being deployed within California, that many people and businesses would up and move to more free states, less regulation perhaps, less taxes, right? And we've seen that over the last 2 years. Certainly so across Arizona, a lot of Californians moving into Arizona, Texas, Nevada, and so forth, right? Moving their way over to the east. But if we read on here, you can see while California may be sitting on close to $100 billion budget surplus, it's also sitting on an estimated $1.5 trillion in unfunded local and state pension liabilities. It spells disaster. Reading on here, compounding the situation is an 11% drop in personal income tax revenue. Shocker. Shocker. Nobody could have seen that coming, right? Further down in the article, it says a net 280,000 people left the state in 2021 for various reasons. So that's just one year right there, guys. And we're seeing about 250,000 people, a little over 250,000 of people leaving the state. I expect we'll continue to see this ramp up. And it's not going to stop as people try to find more free areas to live. I guess the irony in this article is that it'd be curious to know how many of those individuals that have now fled California, what their voting was like over the last 5, 10 years, right? And how on board they were with the policies that they are now fleeing from. Um, and are they going to bring those ideologies into the states that they're coming into? Certainly so, I would imagine. Of course, there has to be a percentage of them that have learned their lesson from this, saw the result of voting in that fashion. Perhaps they won't carry those over to the states that they're now moving into. But of course, there's going to be the other side of that where they will continue to vote this into the states that they move into. So California down the drain, of course, as always, has been happening for years upon years. We're going to move over to Europe here next. This is coming out of the European Union. And this title, this is from the European Commission, so it's going to sound nice and sweet off the title, but we're going to go briefly into what it entails. So crisis-proofing the single market, equipping Europe with a robust toolbox to preserve free environment and availability of relevant goods and services. So basically what they're saying here out of that sweet title is that they're going to try and force businesses that are members of a European Union nation that they can only sell, purchase, keep inventory of goods and products that the EU believes need to happen. So I guess a simple way of putting this is like in wartime, right? You would see a steel factory no longer produce, say, steel appliances, but instead they're going to be moving over into armaments, military backing, things like that, right? So you can see an application similar in wartime when now we're seeing the European Union Commission also begin to deploy tactics as we would see in wartime, limiting what businesses can produce, what they can sell, things of that nature. And this was a press release out of this morning from Brussels, the European Commission. So be sure to check that out, read through it. They do go more into detail of exactly what I just laid out in the framework. But it's the EU is a dictatorship. I'm telling you guys. There's many, and it's not like they're the only one, but they are definitely falling into that category. So we're gonna hop back over to the United States real quick with Peter Schiff, economist. He goes on to say this morning, home building sentiment fell for the 9th month in a row to a much lower than expected 46, the lowest since May of 2013. Given the monthly mortgage payments to buy a home have risen by 85%. 85%, people. Tell me if you can afford that, right? In the past 2 years are headed much higher. Sentiment has a long way to fall. I agree thoroughly with this. He continues on to say, actually, the 85% jump in mortgage payments was based on a 6.1% mortgage rate. I just noticed the rate jumped to 6.4, so all these figures are going to have to be readjusted, right? Over the weekend, that 6.4 figure came in. Peter Schiff goes on to say, we'll hit 7% soon. That will more than double the price of financing a new home from 2 years ago. How many Americans can afford that? So it's just going to keep getting worse. And if the Fed wanted to reel this in, I know I sound like a broken record, guys, but if the Fed wanted to reel in inflation, they would have been proactive on this as far back as 2019. Of course, further than that. But if we're talking in a more immediate term, 2019 is when they should have been more proactive. A lot of the COVID spending that a lot of the COVID spending that we saw come through in early 2020 was a lot of repairs to the debt market that had a catastrophic failure in the fall of 2019. So you got to follow the money. As cliche as that is, follow the money. It's going to show you a clear picture of what's really going on behind the scenes. So moving on to the next story. Not a lot to cover today, so it's not another story, but we're going to go into the cyber threat map as we do every day. Give this a minute to populate. We should see it pick up a bit more. There we go. More inflows, more outflows. And this is about average of what we've been seeing over the last week to 2 weeks with a ever increasing amount of attacks coming. It's not just input to the United States, but we're certainly outputting as well. Asia Pacific certainly a lot more active than normal from what I'm seeing here. Eurozone a little bit more elevated than normal. But yeah, we're getting pelted. Euro's getting pelted. We're sending, we're receiving. So if you're noticing those latencies and internet speeds, Amazon Web Service applications or applications that are hosted on AWS, those are going to be slowed. We've seen a ton of attacks into the Google infrastructure. There's a bit of information coming around for a possible large-scale Google hack. And the first week of October. It's Monday, guys. If you guys can't tell, I'm tired a bit. I need another cup of coffee. It's 1:30 my time over here, but I'm still waking up. But we'll expect this to continue. So let's hop over to the European Union day ahead power prices. The Eurozone, not European Union necessarily, but Eurozone. And where are we at? We're right back up. So if you guys saw, I believe we talked about this. It was recently. If not Friday, it was Sunday. I can't recall. I think it was Friday. Prices were down given the Gazprom, or not Gazprom, but deal with Germany to go ahead and acquire 3 more power facilities that were Russian owned. It looks like that deal might be on the hinges, but as I stated back then, even if they did acquire such facilities, it is not enough to fix the energy crisis that currently is eating away at the European countries. This is crazy. So we're up 32%. I think when we talked about it on Friday, a lot of them were down like as high as minus 62, 66%. Now we're seeing a 25% quarter hike. The highest I'm seeing right here off the top looks like Germany. So it looks like there was some bad news. I'll have to look into that. Some bad news on the purchasing of those 3 facilities. But they're up 46%. So this is volatile, extremely volatile. More volatile than Bitcoin, right? Or crypto. But speaking of crypto and economics and the financial situation, let's hop over and wrap up today's daily brief with a look of equity markets, debt markets, etc., as we do every day. So hopping onto a daily time frame, let's look at the 10-year yields. We've reached a level today that I've spoke all last week that we did not want to see happen. Although we are seeing a pullback from breaching that level, so it could be viewed as a deviation. So we're looking at 10-year yields on a daily, so each candle equals 1 day. And I mentioned that we would not want to breach higher than the June 14th high of 3.5%. This morning we did breach above that just barely, up to about 3.527%, and that was met with a pullback. So if we look at a lower time frame viewpoint of this, we're going to look at the hourly. So you can see earlier this morning we breached right above. We're using this 50 EMA as support. Every time we come down to it, we're getting a nice bounce, but we are getting tighter and tighter. And we have this resistance, which is going to be this horizontal line. So we're just kind of squeezing in between. So we're definitely due for a move. If we break above this, it's going to soar. Markets are not going to like that. I guarantee you we're going to see a lot more downside. Even if we don't get 10-year yields surging, we'll certainly see a pullback in the markets still to come, as I've spoken. At the end of the day, they have to collapse the system to be able to implement a new system, which will likely be a central bank digital currency based, possibly even doing away with the entire SWIFT system as we know it. But looking at this on a relative strength index perspective, which is going to be up here, we're not necessarily making higher highs just yet. We have this high here, which I would expect we might get another ramp up, which could present a deviation and send us right back down, but relative strength's barely holding on. So this will be interesting to watch over the next 24, 48 hours. I would say, honestly, even 12 to 24 hours, we'll see a big move occur. So interesting there. Moving back over to the daily, let's look at the dollar, see how the dollar's doing. We've talked about this nonstop. Of course, RSI has been getting consistently weaker. I am in anticipation of a heavier pullback, likely into the range EQ of this perforated line here, or as low as 104 into this demand zone and a wick down to the 200 EMA, right? So we'll see how this develops over the course of the week. If we see a pullback on the US dollar, expect commodities such as silver, gold, food, items of that nature, commodities to surge. It'll definitely bring some relief over the equities market. It'll bring a relief to the crypto market. All these assets are priced by the dollar. So when the dollar gets a pullback, it gives breathing room to commodities, crypto, other assets of that nature to be able to get back some, regain some levels before ultimately further downside. If you guys have been following me for a while, you know my opinion on this. The debt market implosion is coming unless a different card's played outside of the economic scene that brings the whole house of cards down. But if nothing else fails, it will certainly be the implosion of the U.S. debt market. Also global debt market, really. We're all stuck in the same game of debt, and We can't keep kicking that can down the road any further. But look, guys, I feel like I've taken enough of your time today. I hope you all had a great weekend. I hope you're having an excellent Monday, great start of the week. Be sure to like and subscribe if you like this content. If you guys want to buy me a coffee or just support the Year Zero Report, keep the lights on, head over to Year Zero Report Patreon. You guys can see different tier selections there of different services I offer. But I love you guys. Stay true. Be good. And I'll catch you tomorrow for another daily brief.